Hello traders, welcome to your Follow the Bots S&P 500 Daily Market Recap, sponsored by Zaner. Since 1980, Zaner has been helping futures, commodity, and forex traders trade smarter, faster, and easier.
Hello traders, Builderie here with Follow the Bots. Welcome to the Daily Market Recap, a detailed review of the market structure and the key support and resistance levels in the S&P 500 E-mini. Today is Sunday, September 8th, 2013. Following the August 18th breakdown, when the S&P transitioned out of the consolidation range that had developed for the better part of a month, when the market had auctioned up to the multi-year high at 1705, and price transitioned out of consolidation and traded down below 1670, the S&P has been in a process of building a base of support in the developing trading range between the key support level at 1620 and the upper supply cluster edge at 1670. The market attempted to auction back to the high at the end of August in what we deemed at the time was a short covering rally. Following the short covering rally, price traded back through the entire trading range and went on to make a new low, trading down to 1624, 1625. Having spent sufficient time, 3 consecutive trading days, accumulating positions at the newly made low, this week we witnessed the S&P auction back up through the prior trading range, and on Friday the market auctioned back up to 1663, shy of the prior high at 1667, but at or near the transition point at 1670. On Thursday, the S&P traded above the minor resistance level and filled the gap at 1654. However, there was no upside momentum on Thursday, and the S&P traded in a narrow trading range with very little price movement through the end of the session. Following the minimum development that occurred during Thursday's session, on Friday, ahead of the jobs number, S&P futures auctioned above Thursday's high and traded up to 1663 in the overnight session. On the announcement of the jobs number, the S&P sold off from the high, traded below the prior day's low, and auctioned back down at or near Wednesday's low, trading down to 1640, 1638. After trading down to the low on Friday, the market reversed direction, rallied back up to the high, before ending the session at 1654. For a detailed look at Friday's market development, we'll turn our attention to the point and figure chart. During the overnight session, S&P futures pulled back at or near 1650, 1648. This had been an over-under point, and the market had encountered resistance at this price level, had held support at this price level several times during the developing trading range. Here's the activity we see during the overnight session and at Friday's open. When the jobs number first came out, the market retested the high. Then, during the minor pullback to 1658, the selling pressure increased and the S&P sold off exponentially, trading below the prior day's low, trading down at or near 1640. There was a minor pause at the 48 price level, but when the S&P auctioned back up to the minor resistance level, the one place where the market had paused and where the selling pressure accelerated, there was no secondary sell response. It was at this price level that the true nature of the sell-off was revealed. If indeed the market participants were going to liquidate their long positions and sell off through the trading range, it is here on the retracement back to 1648, 1650 that the market would have encountered a sell response, and the S&P would have sold back down to the low and went on to make a lower low. However, when the market auctioned back to 1648, 1650, the computerized trading algorithms began executing to the buy side. This produced the short covering rally, and the market auctioned all the way back up to the starting point of the decline before making a modest pause, and went on to trade back up to the opening range high and did not sell off until the end of the day. For a closer look at the order flow events that developed during Friday's session, we'll focus our attention now on a 5-tick range chart. On this chart, we have two digital filters. We have the Kalman filter and we have the Gaussian regression filters. Also surfaced on this chart are the order flow events detected by the Skeeto algorithms. The combination of the digital filters and the order flow events provide a great insight as to the nature of the developing price action. Here we see at the high, initially buying interest wanes. Then the computerized algorithms begin executing trade on the sell side. When the market pulls back down off the high at or near 1658, the selling increases. During the exponential decline, there was no uptick to get short. The trader who wanted to get on the sell side had to be willing to initiate a short as best he or she could. The order flow algorithms alerted you to the fact that the trading bots were aggressively initiating to the sell side. The selling was exponential until price auctioned down to the bottom of the polynomial channel. There was a minor pause and an uptick, but the uptick was met by more initiated selling, and the market continued to trade lower, auctioning down at or near 1638. Astute market observers in the S&P would have recognized that 1638 was the upper edge of the demand cluster that had been developing at the low. Therefore, we would have expected to see the sell programs back away as the market had traded down the distance of a Markov sequence, 17 to 23 points below the high, and indeed the order flow monitor detected sell programs waning, followed by initiated or high-frequency buy programs being executed by the computerized algorithmic trading bots. Here is where the issue comes in. The market had paused here earlier and went on to make a lower low. Therefore, the expected reaction when price traded back to 1648 would have been for the market to pause, for more selling to develop, for price to retest the low, and potentially go on to make a lower low. That description would have fit the pattern if indeed the market participants were truly liquidating their long positions. The initiated buying at the 1648 price level indicated that the previous sellers were buying back their short position, and hence the potential for the market to auction back to where the selling had begun. This is called a rout of the trading range. A rout is a military term. It refers to a disorderly or chaotic retreat. It is a military maneuver or a tactic that is used to put one's opponent at a disadvantage. Indeed, the average trader, the retail trader, is trading against large financial institutions. They have developed a variety of maneuvers or tactics to shake out retail traders and to trigger stops and force margin calls for those who are trying to follow them up. Therefore, the initiated buying that was occurring when price traded back to 1648 was the alert that the motivation was not to liquidate long positions, but was instead to rout the trading range, to trigger stops, and to shake weak players out of their long positions. Those who continued selling into the rally were disadvantaged or penalized. Later in the day, the market did pull back to 1653. However, that did not occur till the market sat flat at the high for several hours. This flatlining at the high is also part of the tactic or the maneuver. The duration of time that the market spent flat here at the high was for the purpose of frustrating anyone who had sold into the trading range and forcing the sellers to capitulate and abandon their short positions. The final uptick back to the opening range high met with buy programs waning, followed by high-frequency sell surges, and the S&P pulled back to 1658, 1657, and then sold down to 1653 into the close. We would encourage our listeners to do some investigative research on the Kalman filter and on the Gaussian regression filters. These are not simple moving averages. These are sophisticated algorithms that are calculated on multiple variables, and they can be trusted to point out, in the case of the Kalman, the general direction of the order flow sequence, and in the case of the digital filters, the micro price series. When you accompany these digital filters with the order flow algorithms, you're receiving a great deal of information to help you decide, shall I remain a seller or shall I wait until the direction pauses, until the buy programs waning with the high frequency sell surges occur? Should I be a buyer when I see the slope of the filters pointing exponentially lower, and when the high frequency computerized algorithms are executing exclusively to the sell side? There is no shortcut to trading. There is no holy grail that is going to tell you what decision to make at every moment. But this combination of the digital filters, Kalman and Gaussian, and the order execution events by the trading bots provide the retail trader with the information they need in order to get on the right side of the market direction. That concludes our daily recap for this Sunday, September 8th, 2013. If you would like to follow our real-time commentary, we invite you to join us online at www.followthebots.com. We'll look forward to seeing you some morning at the open.
For more information regarding Zahner's brokerage services or the content of this broadcast, contact Neil Rogers, nrogers@zahner.com, 312-277-0135. This is Cuerva from Follow the Bots. Happy trading.